Welcome to the debate. In 1950, 52% of 30-year-olds owned a home and were married. Today, that number has collapsed to like a staggering 12%.
Yeah, it is a completely different financial universe right now.
It really is. The fundamental laws we thought governed wealth building seem to be shifting entirely under our feet. For a young professional looking at their financial future today, the standard operating procedures of the 20th century, well, they can feel entirely inadequate. We are looking at a stark divide in how experts are diagnosing the modern economy, and more importantly, how they are advising the next generation to survive it.
Right, because the floor has essentially fallen out from under them. I mean, the reality is that young people today are operating in an economic macro environment that punishes the exact conservative behaviors that used to guarantee a middle-class life.
Which brings us to the central question we are exploring today. In our modern economic reality, is the traditional path of building wealth through passive index funds and skill building still viable? Or has extreme currency debasement made aggressive risk-taking a logical necessity? I'll be representing the traditional side today. My perspective is rooted in the enduring math of discipline, meaning I firmly believe that passive index funds like the S&P 500, combined with deploying capital into high-leverage skill development to boost your baseline income, is the safest path. Above all, I advocate for avoiding the catastrophic emotional pitfalls of highly volatile assets.
And I'll be taking the other side. My perspective is that the old economic model is fundamentally broken. Heavy allocations in high-growth tech stocks, specifically the NASDAQ, and digitally scarce assets like Bitcoin are no longer speculative gambles. They are, quite frankly, mathematically required to build real wealth in an era of rampant money printing.
Let's lay out the mechanics of the traditional approach first, because it is rooted in undeniable historical math. The premise of slow, disciplined compounding has created multi-generational wealth for decades. If a young professional simply invests, say, $1,000 a month in a broad market index like the S&P 500 over 30 years...
Assuming they actually have $1,000 a month to spare.
Right, assuming they have it. But if they do, that capital historically grows to about $1.9 million. That isn't theoretical, it's a measurable baseline driven by the actual economic output of the 500 largest companies in the United States. Furthermore, for young professionals who inherently have limited capital, the absolute best return on investment comes from personal leverage.
Personal leverage.
Yes, investing in oneself to increase earning power. Rather than just taking a generic online course, I'm talking about stacking high-income skills to build a personal monopoly. If you combine fluency in, say, AI prompt engineering with data analysis and digital marketing, you become unfireable, you create a unique value proposition that yields exponentially higher long-term dividends than gambling on highly speculative digital assets.
I'm not convinced by that line of reasoning, because rejecting the proven mechanics of compounding and suggesting that young people must take extreme risks entirely dismisses human agency. You can increase your income, you can live aggressively below your means, and you can let time do the heavy lifting in the broader market. I'm sorry, but I just don't buy that. Let me tell you why. That $1.9 million figure you just cited it's an optical illusion. The traditional advice you are touting is completely oblivious to the macroeconomic reality young people face today. You mentioned the collapse in homeownership among 30-year-olds at the top of the show. Why is that happening?
I mean, mostly because of inflation.
But it's deeper than just standard inflation at the grocery store. When the government continuously prints money to service massive, unpayable sovereign debt, they are expanding the money supply. Assets like houses, stocks, and land aren't inherently becoming more valuable. The paper money you are using to measure them is simply becoming worthless.
The gap is certainly widening, yes.
It's not just widening, it's a chasm. The research we're analyzing today highlights a brutal mathematical trap. Average salaries are only growing at roughly 2 to 3% a year, while scarce assets are rising at 12 to 13% a year. Young people are trapped in it. Therefore, they effectively have nothing to lose. They must seek outsized returns, like Bitcoin's historical 145% annualized return over the last decade, just to close that gap. Traditional compounding at 8 or 10% mathematically guarantees their future self will be poorer in terms of actual lived purchasing power.
Okay, I think we need to ground this in a very practical reality. If you're a 25-year-old listening to this right now, you might have, your first $1,000 of disposable income to invest. We can debate macroeconomics all day, but what do you actually do with that first $1,000?
Exactly, and putting it in the S&P 500 isn't the answer.
Well, I actually agree that putting it in the stock market right away isn't the best move, but for very different reasons. If you put that $1,000 into an S&P 500 index fund, assuming historical averages, it yields about $100 in a year.
Which is nothing.
Right, I readily concede that $100 is not life-changing. But this is exactly why that initial $1,000 should be spent on education to create what we call a knowledge arbitrage.
Explain how you see that working in today's economy, though.
Well, established businesses have capital, but they lack technological fluency. A young person could spend that $1,000 on deep dive technical books, premium software subscriptions, maybe high-level certifications in automation or artificial intelligence.
Okay, but
Let me just finish the thought. By simply understanding the instruction manual of modern tools better than a 50-year-old executive does, they bridge the knowledge gap. They consult, they provide a service, and they can dramatically increase their hourly rate from $20 to $150. That is how you multiply wealth early on. And once that income stream is established, deploying capital into the market works wonders. A $1,000 investment in the S&P 500 in 1971 with dividend reinvestment would be worth roughly $330,000 today without ever adding another penny.
right, but you are citing 1971. A young professional today cannot wait 53 years to afford a down payment on a house or to start a family. The cost of living is accelerating far too fast. If you look at the S&P 500, it takes nearly 8 years just to turn $10,000 into $100,000. To shortcut that timeline, you need assets that drastically outperform the debasement of the fiat currency you are earning in.
So you're saying skill building doesn't matter?
No, not at all. Skill building is perfectly fine, and increasing your baseline income is of course fundamentally important. However, asset selection is what truly multiplies wealth over a lifespan. And knowledge arbitrage is by definition temporary.
Temporary how? I mean, skills stack over time.
Temporary because you learn a new AI tool today and you have an edge. But within 12 months, the market saturates. Everyone learns it. Or worse, the AI learns to do it itself, and your specialized skill is commoditized to zero. Meanwhile, technological network adoption models, which is what these scarce digital assets actually represent, operate on an entirely different scale of compounding.
Break down what you mean by network adoption models for someone who just sees like a ticker symbol on a screen.
Sure. Think about the early internet or the adoption of email. The value of a network increases exponentially as more people plug into it. This is Metcalfe's law. A single telephone is useless, but a billion telephones change the world. Bitcoin and other major digital assets are not just software, they are financial networks. The data shows that cryptocurrency adoption is growing at twice the speed of the early internet. It is literally the fastest adoption of any technology in human history.
Wow.
Yeah. To ignore that massive secular bull market in favor of a certification course is completely missing the greatest wealth generation mechanism of our era. A far more logical allocation for a modern investor looking to escape the wage trap is a portfolio mix of 70% NASDAQ, because tomorrow will mathematically be more digital than today, and 30% digital assets. That specific mix drastically shortens the timeline to financial independence from nearly 8 years down to 5 or 6.
That's an interesting point, though I would frame it differently. Investing in your own skills is like upgrading the engine of your own car. You control the maintenance, you direct the steering, and the increased horsepower serves you every single day you drive across every job you take. Throwing your only $1,000 into a highly speculative asset like crypto is like strapping a rocket to a bicycle. Yes, it might go extremely fast for a brief moment, but it is highly likely to blow up, leaving you stranded with absolutely nothing. When you invest in your capacity to earn, you build a permanent, secure floor under your wealth.
I come at it from a different way. That rocket might be the only vehicle capable of reaching escape velocity in today's economy. Your analogy assumes the car is driving on a level, paved road. The reality is that the road is a treadmill moving backward at a rapid pace due to inflation and asset scarcity. You can upgrade the engine all you want, but if the treadmill accelerates, you are still losing ground.
But engaging with those volatile, high-velocity mechanisms forces the investor into an active, emotionally turbulent environment. And this is where the mathematical theory slams into human psychology. Let's contrast active stock picking and high-risk crypto against passive index investing. The data on this is definitive. 98% of people should be passive investors.
Because of the fees associated with active management?
Well, fees are a huge part of it, yes. Over a 20-year period, passive investors who just park their money in the S&P 500 consistently outperform more than 90% of active stock pickers, especially after you factor in the 1.5% management fees that actively drain a portfolio. But it's not just the fees, it's the psychological toll. The profound danger of highly liquid, high-risk markets is that human beings are fundamentally emotional creatures. When prices plummet, people panic and they sell.
Volatility is the price of performance.
But look at the magnitude of that volatility. In 2020, stocks fell 30%, which is painful enough, but Bitcoin fell 50%. In 2022, stocks fell 20%, but Bitcoin plummeted a terrifying 60%. If you're asking a 25-year-old to strap that rocket to their bicycle, you are asking them to stomach a 70% drop in their life savings just to reach that theoretical escape philosophy. The psychological math doesn't work, even if the financial math does.
I disagree.
But most individuals simply lack the emotional IQ to hold through a 70% drawdown. They check their phones 15 times a day, the anxiety builds, and they liquidate at the absolute bottom, permanently destroying their capital.
Psychological difficulty. You are comparing the S&P 500's average 25% bear market drawdown, which compensates you with a 15% return at best, against a digital asset's 70% drawdown, which has historically compensated investors with a 145% annual return.
I just don't think the average person can survive the 70% drop to see the 145% gain.
They can if they separate their emotion from their execution. It's a fundamental misunderstanding of risk-adjusted returns over an extended time horizon. Yes, volatility is psychologically difficult, but panic leads to overselling, which leads to opportunity, which leads to profit. If you build a mechanical system like dollar cost averaging, where you blindly invest a set amount, say $500 every single month regardless of the price, you remove the emotion entirely.
So you just buy blindly into the crash?
Exactly. When the market drops 70%, your mechanical system is buying at a massive discount, drastically lowering your average cost basis. This means you hit new portfolio all-time highs well before the broader market even recovers. There is a fascinating statistic in the research that proves this point beautifully. The best performing brokerage accounts in the United States belong to dead people.
Dead people? Are you serious?
Dead people. Why? Because dead people don't log in and emotionally sell during a crash. They don't read the panicked headlines. They just hold the asset. If a young investor can mimic the emotional detachment of a dormant account, the volatility becomes their greatest advantage.
But that morbid statistic precisely proves my point regarding the lived reality of investing. Dead people don't lose their jobs during macroeconomic downturns. Dead people don't have to pay rent when inflation spikes. Let me ask you a very pointed question. How can you honestly advise a 25-year-old with consumer debt to mechanically dollar cost average down into a 70% crypto crash when they might lose their job in that exact same economic contraction and desperately need that liquid cash just to survive? You cannot separate the volatility of the asset from the economic vulnerability of the young investor.
Because if they don't take that risk, their financial survival in the long term is mathematically compromised anyway. We have to look at the correlations. When markets crash, asset classes usually move in tandem. Stocks, real estate, and crypto all go down at the same time during a liquidity crunch. If that 25-year-old was passively invested in the S&P 500, they would still be losing their capital exactly when they need it most.
But a 20% haircut on the S&P 500 leaves you with a lot more emergency cash than a 70% wipeout in crypto.
In the immediate short term, yes. But the crucial difference is the speed of the recovery and the sheer magnitude of the subsequent bull run. If they are forced to sell, it's painful either way. But if they can hold, if they can survive that downturn by relying on their income, the high-growth technological asset is the only one that will actually alter their socioeconomic status. Traditional index funds will merely keep them treading water against the rising tide of asset inflation.
Which leads us directly into what I think is the most philosophical contention we have today. Is this aggressive risk-taking actually a logical necessity? I fundamentally reject the premise that young people have nothing to lose. They have their initial capital, they have their time, and they have their psychological well-being to lose.
But you have to view this through the lens of the macroeconomic realities we discussed earlier. What traditionalists fail to understand is that the system itself requires this risk. Let's use a very simple analogy to explain the mechanics of fiat debasement. Imagine we all have a limitless stack of paper money on a table in front of us, and we are bidding on a simple coffee mug.
Okay.
Because we have unlimited paper, we quickly bid the price of that basic mug up to $150.
But the mug didn't change.
Exactly. The mug didn't become fundamentally more valuable. It still just holds coffee. The paper money used to measure it became worthless. That is exactly what is happening to housing, groceries, and the stock market today. The system is systematically creating excess money to service massive, unpayable sovereign debt. And it's doing this exactly as the population ages and economic productivity slows down. In this specific macroeconomic reality, adopting a traditional conservative strategy guarantees a poorer future self. Taking aggressive risk in scarce digital networks isn't a speculative gamble. It is a mathematical necessity to outpace the rapid, deliberate printing of fiat currency.
I see why you think that, but let me give you a different perspective. Betting entirely on a speculative digital asset to escape inflation is reckless because the asset itself lacks intrinsic economic mechanisms.
Define what you mean by intrinsic mechanisms.
Well, I mean tangible cash flow. Unlike real estate that provides physical shelter and rental income, or a productive company like McDonald's that generates billions of dollars in real profits and pays actual cash flows to shareholders in the form of dividends, Bitcoin has no underlying tangible value. It produces no yield inherently. Relying on an asset that produces no dividends is essentially hoping for the greater fool's theory to play out.
The greater fool theory.
Yes, hoping that someone else will come along and buy it from you at a higher price later simply because it's scarce.
You call it the greater fool's theory. I call it a verifiable network consensus.
But it doesn't produce anything.
Neither does gold. Gold has very little industrial utility relative to its massive $15 trillion market cap. It just sits in a vault. Human beings simply collectively agreed it has value as a store of energy. Digital scarcity operates on the exact same human consensus, but unlike gold, it is computationally enforced, easily transportable, and instantly verifiable across the globe.
Even so, the lack of a dividend means the investor receives no protection during the waiting period.
Let's talk about those dividends for a second, though. A 4% dividend yield is mathematically meaningless to a young person starting with $1,000 or even $10,000. It requires massive accumulated capital to generate livable cash flow. Young professionals don't have decades to sacrifice while a tiny 4% yield slowly trickles in, especially when the underlying currency that dividend is paid in is losing 8 to 10% of its purchasing power annually in real terms. Advising them to play a game where the rules have been changed to ensure they lose is what's truly dangerous. It traps them in a perpetual cycle of working harder for money that buys progressively less.
But the companies comprising the S&P 500 are not static, helpless entities waiting to be debased. They are dynamic organizations filled with brilliant engineers and executives actively adapting to inflation. Explain how a company reacts when raw material costs go up.
They raise prices.
Exactly, they raise the prices of their goods and services. Their corporate earnings grow nominally in tandem with inflation, which inherently protects the shareholders' purchasing power over time. You don't need a revolutionary, highly volatile digital paradigm to capture that protection. You simply need to own equity in productive human enterprises.
That works in a growing economy, but the research makes it incredibly clear that the economic engine of population growth and productivity that drove the S&P 500's historical returns is stalling out.
Stalling in what way?
Demographics.
The engine of the S&P 500 relies on perpetual population growth to drive consumption. When you have an aging demographic in the West, meaning there are more retirees pulling money out of the system than young workers putting productive capital in, that organic growth engine stalls. Combine that with a suffocating debt burden, and the math changes. You simply cannot rely on the past 50 years of stock market performance to blindly predict the next 50 years when the fundamental demographic inputs have inverted.
Which means, in your view, they have to abandon the old ship entirely? Well, as we draw this discussion to a close, let me summarize the traditionalist perspective. The enduring math of financial discipline remains the safest and most reliable vehicle for achieving financial independence, regardless of demographic shifts. By focusing on increasing your personal leverage through relentless skill building, maintaining a conservative lifestyle, and allowing your capital to compound safely within passive, highly diversified index funds, you build a fortress of wealth. You don't have to rely on perfectly timing a volatile market, and you don't have to endure gut-wrenching 70% drawdowns that might force you to liquidate at the worst possible moment. It is a proven path of security and productive output over high-stakes speculation.
And my position remains that in a world defined by rampant, mathematically certain currency debasement, extreme caution is actually the riskiest behavior of all. Young professionals are operating in a fundamentally altered economic paradigm, taking aggressive, calculated risks in high-performing technological networks, specifically the NASDAQ and digital scarcity, is no longer reckless speculation. It is a logical, necessary adaptation. It is the only way to reach escape velocity and free themselves from a system designed to slowly but surely drain their purchasing power.
Despite our stark differences in asset allocation and our opposing views on macroeconomic realities, there are clear points of convergence in our analysis today. We both entirely agree that keeping cash sitting idle in a traditional bank account is a guaranteed loss.
Absolutely. With inflation silently eroding purchasing power every single day, being a pure saver is a massive financial mistake. Capital must be deployed into assets.
And we also completely agree that managing human emotion, controlling the psychological urge to panic during inevitable market volatility, is the single hardest part of any investment strategy.
Without a doubt, whether you are holding a passive S&P index fund through a prolonged global recession or holding a digital asset through a violent 70% drawdown, emotional discipline and having a mechanical system in place is paramount to survival. The mind will always be the investor's greatest enemy.
The data and perspectives we've explored today reveal deep, structural complexities in modern personal finance. It leaves each listener with a profound choice regarding how they navigate this shifting economic landscape. We aren't here to declare a definitive winner or to tell you exactly what to do with your first $1,000. The decision rests on what you value more and how you perceive the world around you. Do you trust the historical stability and adaptive, productive output of traditional compounding, or do you see the necessity for the high-stakes, high-growth potential of the new digital economy?
There is certainly much more nuance to explore in these concepts to help you make that determination for yourself. Every young investor has to look at the macroeconomic data and decide which risks they are willing to take.
Think back to the sheer scale of the shift we discussed at the very beginning. Classical financial physics tells us the S&P 500 is a constant, reliable force. But if you suspect the economic ground is permanently shifting beneath your feet, if that 52% homeownership rate has truly collapsed to 12% for good, you are faced with a monumental decision. Do you painstakingly reinforce the traditional foundation of your house, hoping it withstands the storm, or do you take the massive, terrifying risk of trying to build a plane while it's accelerating down the runway?